Good morning, everyone. We appreciate you all for taking the time today to join us for today's ATRAM market update. Let's get right to it. We brought in a few individuals who can help us update on the latest news and insights surrounding the market. I'd like to introduce our three speakers this morning: ATRAM's Chief Investment Officer, Mr. Philip Hagedorn, ATRAM's Multi-Asset Portfolio Manager, Mr. Dustin Ang, and ATRAM's Fixed Income Portfolio Manager, Mr. Lodevico Ulpo. The format for this morning's webinar is going to be, first off, an introduction by our Chief Investment Officer, and then we'll hear an update on global markets, and then finally fixed income markets. We will aim to leave a few minutes at the end for Q&A. However, before we begin, I'd like to remind everyone that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section. We will get to the questions at the end of the discussion. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day, as well as posted on all our social media pages. Let's kick things off with our Chief Investment Officer, Mr. Philip Hagedorn.
Thank you, Santi, and good morning, everybody. Thank you for joining us again today for our usual Thursday update. Just want to start off with a bit of a broad picture as to what sort of the concerns for this last few days have been for the team. And clearly it revolves around the economy, and it revolves around the impact of the economy of the quarantine measures that are ongoing today. The big question really is the length of this quarantine, and our most recent forecasts and numbers are anticipating an extension of the quarantine of about 2 weeks as a minimum, and then a more limited type quarantine for another month and a half beyond that. So we're optimistic of a slowly improving situation, but the impact of this quarantine is going to be quite severe on the economy. We are now looking at potentially at least 2 quarters of negative growth with a recovery in the fourth quarter to bring our annual GDP rate somewhere around 2 to 3%. Again, these numbers are constantly moving, and they have a lot to do with where quarantine takes us and the length of this quarantine. But again, we feel this is a key measure that the government is taking and must be followed, and we support it. And we hope also that that we're able to transition to a more limited quarantine by May. Just to look at some numbers, purely numbers on this virus as well. I think, and looking at a few countries, China obviously peaked at 81,500 cases with 3,305 deaths. That rate around the 4 to 5% range, which is the same global number. But clearly a very low increase in new cases in China from the numbers we're seeing. Interestingly enough, Italy, I think, is a good example where the infection rate over the last 5 days has increased by about 11%. But very different from around the middle of March, where during a 5-day period in the middle of March, the infection rate increased by 76%. So clearly there looks to be a slowdown and a flattening there. The numbers still look like they're rising, but the rate of moving higher is certainly slowing down, and that's what we hope to see in the Philippines. And if that is the case in the next few weeks, then we certainly would expect that the limited quarantine scenario comes into effect in May, and we're able to start recovering from this slide that we've had. Today you're going to hear from two of our teammates, two of our key members of the team, Dustin on the multi-asset and Devi on fixed income. They'll give you an idea as to where markets have gone over the last few days. And more importantly, some ideas as well. I think, where we are in this cycle is that my feeling is the panic in the market has subsided for now. Doesn't look like the market is acting very panicky at this point. At the same time, we're able to take a step back and start looking at some fundamentals and make some assumptions where we can generate some ideas for you. So I think today's goal is to really give you an update on the global markets, which Dustin will do, and local equity markets as well. And for the fixed income markets, we'll hear from Devi for the outlook and some strategy. I guess if I were to just summarize the last week's trading activity from last Thursday, it's again more stability. I think more sanguine approach to markets seems to be coming through. Volatility has reduced substantially, although it's not disappeared, and by no means are we out of the woods. But at least from the way the markets have been behaving, in the Philippines in particular, it seems like more rational behavior going on. So I'll leave it at that for today. Again, I thank you for joining us today. I hope this webinars have been helpful for you. Please make sure you send our questions over, and we'll do our best to either tackle them on the call or after the call and have those answers posted as well. So thanks again for joining us. Stay safe, everybody, and have a good day.
Okay, thank you, Phil. Let me remind everyone to please continue asking your questions using the Q&A button on your screens. We'll get to them at the end of the discussion. Moving on to the next phase of our webinar this morning, I'd like to pass the mic over to Mr. Dustin Ang, who will take a closer look at our current situation as a whole.
Good morning, everyone. I hope everyone is staying safe at home. I'm sure all of us are caught up with some of the headlines around how volatile markets have been. So I'll be going over different asset classes today in the context of a multi-asset portfolio standpoint. We'll be talking about local and global markets across equities and fixed income, and then relating them all together. So at the end of the presentation, my goal is to instill a better understanding of how you may want to adjust your portfolio if you're managing it yourself, or if you already have a multi-asset portfolio with us, you can expect that these views are they already translate to your positioning. Okay, let's move on to the first slide. Okay, starting off with our outlook on global equities, I have plotted the US equity index, or the S&P 500, at the top half of the chart. At the bottom, I have plotted the PE ratio during the same period. The first thing I want to highlight is how much US stocks fell during the 2008 global financial crisis. Equities fell 56% from the peak to the bottom over more than a year. Today, we've seen a drop of only 22% within a very short time frame, which is basically less than a month. And it can be quite messy to just look at the index levels in terms of gauging when to exit or enter. For that, I use the PE ratio as a measure of valuation during these times. And I would take this with a bit of grain of salt, given that the earnings downgrades haven't quite materialized just yet. But it's a good measure of valuation right now. So you can see that the PE ratio hit a high of 20 times back in 2017, which was basically a Goldilocks period for the US. So I think that valuation is justified. In 2018, the valuation hit a 5-year low at 14 times PE because, as you may recall, we were grappling with a US-China trade war, and the US Fed, the Federal Reserve, was still hiking interest rates. Actually, looking back, Given the current situation, it seems like the trade war seems like a more muted uncertainty at the time. But anyway, if we look at what current valuations have done, the recent sell-off actually bounced back once it hit the 14 times. So that served as a support last week. Given the historic rally we've seen that started last week, we're now back within the 5-year range for the PE. So this tells us a few things. First, the current valuation level is indicative of normality, which we definitely are not at. Second, if or maybe when the new cases of COVID-19 in the US spikes in the coming weeks, there is still a considerable amount of downside. And I think even that downward lower bound, that lower bound of 14 times may not even be justified. Lastly, the market has fallen so drastically because we have to remember that we have come from all-time highs before the outbreak happened. So this translates to our strategy, which is to basically keep an underweight allocation in global equities. For the minimal exposure that we have, we prefer globally diversified positions, and we have a preference over dividend-paying strategies. So the reason for this is that companies that consistently pay out dividends are typically those who have relatively more stable fundamentals and can therefore weather more financial distress. Um, that's not to say that all companies that pay out dividends are going to be safe. I'm sure you've read some headlines that some companies that actually have deferred dividends, but in general, companies that are more consistent in paying out these dividends or those are the blue chip companies, more defensive ones, that are more, I mean, on a relative basis, more equipped to handle this financial distress. And lastly, uh, look for active managers in the global equity space and not just the passive ETF, especially given the current high volatile environment. Okay, so let's move on to the second slide. So here, I've used the same set of charts and applied it to our own local equity market. And using the same analysis, we can see that in 2008, the PSEI fell 54%, also over more than a year. In the recent sell-off, we've only fallen 34%. I took these levels a couple of days ago when we were at 5,300. More interestingly, if we look at the PE ratio of the PSEI, you can see that before the COVID-19 sell-off, our PE actually traded very nicely within a range of 16 to 21 times PE. Of course, because earnings growth have improved significantly over the years, even if the PE traded over a range, this translated to the PSEI return appreciating slightly from a trend perspective. But you know what we've seen in the recent sell-off is that the PE actually broke way below that 5-year range. What used to be a solid support level of 16 times, we're now trading at 10.8 times PE. Now that's a huge drop, and it's quite indicative of the panic selling we've seen. Um, and we can debate whether or not this level is justified. But the point I want to make here is that we are currently trading at this level of valuation. And we're now actually closer to the 2008 GFC level than the lower bound of that range. If we compare our local equity market to the US, we can conclude that we are way, way cheaper than the US, despite having both sold off aggressively. So this translates to our strategy of preferring blue chip names in the local space, specifically owning index funds, particularly good strategy, because these consist of the largest market cap stocks. You know, the reason for this is to take advantage of when foreign flows return into the local market. We think foreign investors will buy these blue chip names first. Okay, moving on to the next slide. Okay, now let's look at the fixed income markets. I have two charts here, and let's focus on the first one. Here I've plotted the 10-year bond yields for the respective local government bond and US Treasuries. So we're comparing both government bonds. Obviously, the 10-year Philippine bond trades at a premium yield over treasuries, given that we are an emerging market. Our potential growth rate is higher than the US. But what's interesting to note here is the spread between the two bonds. After the last 5 years, the average spread is at 200 basis points or 2%. Given the COVID-19 shock, we typically see bond yields drop as investors reduce their equity exposure and shift into bonds. Um, Investors preferring more of the safe haven assets. So when people rush into bonds, bond prices rise and bond yields come down. And you can see exactly that in U.S. Treasuries, which is the lower line there in 2020. We actually saw the 10-year U.S. Treasury yield start the year at close to 2%, and by today we're closer to 0.6%. More interestingly, if you look at what our own 10-year government bond did, its yield actually spiked higher. Um, this is due to a lot of factors, the lack of liquidity being one of them, and Devi can discuss this in more detail later on. But the point is that the current spread between the two has now widened to 400 basis points, which presents an opportunity for us in local government bonds. Current market pricing still does not reflect where yields should be given the current environment, and there is considerable return potential here as compared to US bonds at this point. So now moving on to the bottom of the chart, I mean the second chart, touching briefly on corporate bonds now. I've plotted EM spreads, emerging market spreads, to include the period of the 2008 global financial crisis. As you can see, corporate bonds sold off to the point that spreads widened. Spreads versus US Treasuries widened to as high as 900 basis points, 9%, as people sold out of corporate bonds. So this indicates not only panic, but a wave of corporate defaults, credit defaults after mortgage-backed securities blew up. Comparing spreads to today, we can see that spreads have already widened by 300 basis points due to people selling out of corporate bonds. And we see a potential for further widening up to the level we saw in 2008 as we expect defaults to come. And they haven't come in a significant way just yet. And this is especially from the double whammy of business disruptions from COVID-19 and the price war in the oil markets between Saudi and Russia. To better relate basis points into actual return, if some of you hold global corporate bond funds, don't be surprised to see year-to-date returns of negative 15 to 20%. I urge you to take a closer look and to not be complacent, to think that bonds are a safe investment relative to equities today. When the market turns optimistic, you'll see equities rebound quite aggressively, and sentiment can turn on a dime. Corporate bonds are a completely different story. A credit default means that companies don't pay back their creditors, and there's no bouncing back from a credit default. So a bit of caution there. Our strategy is to stay away from corporate credit risk, given our outlook of potential credit defaults. We also prefer local government bonds over US Treasuries at this point, given the dislocation in spreads. If you want to enter in a local corporate bond fund, make sure you invest in those that use a hold to maturity valuation methodology, so you don't get hit on the price movement on a daily basis. If you guys have been monitoring local bond fund returns, you'll see that it's around slight negative 1 to 2%. Um, Shameless plug to our in-house ATRAM corporate bond fund, which is up around 0.7%, given that we are using that hold to maturity valuation methodology. Okay, moving on to the next slide, please. Okay, in this next slide, I want to quickly highlight some of the catalysts that, in my view, led to the rally that started last week. I'm sure all of you have questions surrounding this. Particularly, we saw significant intervention from both the Federal Reserve and the Trump administration. So that's basically an expansionary push from both the monetary side and the fiscal side. in trying to contain the COVID-19 shock. If there are economists listening in right now, this means that the US is trying to shift both the IS and LM curve to the right in trying to boost the economy in a huge way. The reason this is so significant is because both policies, monetary and fiscal, are pulling out all the stops in quite an unprecedented fashion. On the monetary side, we've already seen the Fed cut interest rates by 1%, close to 0%. They also amended their quantitative easing or QE program to infinity. Basically, they're buying unlimited amounts of bonds just to keep yields low. They've also opened a number of facilities to help provide liquidity directly to failing businesses, both primary and secondary markets also. The list goes on. I've actually just listed quite a few points here. On the fiscal side, the administration recently passed a 2.2 trillion, to be exact, $2.2 trillion relief package that entails rebate checks to households. So that's $1,200 for each adult, $500 for each child. They're also providing loans to small businesses, expanding unemployment benefits as well. So $2 trillion, a lot of money. It can be quite difficult to gauge how significant this actually is. $2 trillion, just for context, is around 10% of GDP. Um, it's more than a quarter of their full year budget in 2019, and it's way larger than the relief program they did in 2008. So it's quite astronomical. Now, after I've elaborated on these points, some of you may be thinking, that's great. You know, like we should be bullish right now. We should basically buying all these equities up. But I'd also like to highlight in that bottom chart we have there, we're now only seeing the cases of COVID-19 starting to spike in the US. And I think it's going to get rougher in the coming weeks. Um, we expect more lockdowns and the credit defaults haven't even happened yet in a big way. So our view is that this rally might not be sustained in the short term. That rally being fueled basically by these catalysts of the monetary and fiscal policy announcements. After this, however, we don't see a lot of catalysts going on, especially given that we have to expect economic data that is expected to come out to show some of the slowdown economically. Okay, moving on to my last slide. Putting it all together, these are our views for each asset class in the context of a multi-asset portfolio. Starting with our negative views, we're bearish on the peso in the coming weeks. We think the BSP has way more room to cut interest rates than the Fed. The Fed basically has used up all their dry powder already, having cut rates to 0.25%. Another leg of global sell-offs will also cause emerging market currencies to depreciate. Um, we're also bearish on both Philippine equities and global equities for now, given that US valuations are still quite rich. I know I mentioned that Philippine equities are a lot cheaper, but we tend to move alongside global markets, which have further to fall. We might see Philippine equities hold up a bit better, but it may fall nonetheless. On global fixed income, we are neutral overall. The reason is that we don't like corporate bonds in general, given our outlook for credit defaults, but we like sovereign credit instead. So bonds issued by governments. So examples being ROPs and US Treasuries. Moving on to what we like, we are bullish on Philippine fixed income, as I mentioned. Given the opportunity that we see right now, basically yields are still not reflective of the COVID-19 risk. We think the BSP can cut a lot more, and inflation is set to ease. Now, these are all strong signals for Philippine fixed income. We also like gold as an alternative safe haven asset, as we see another potential move lower in equities. And we think gold will stand to benefit. And with that, I'd like to end my presentation. Thank you very much for listening in. I'd be happy to answer any questions later on. Thank you.
Okay, thank you for your insights, Dustin. Once again, let me remind everyone to please continue asking your questions using the Q&A button on your screens. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section as well. We'll get to them at the end of the discussion. Let's now transition over to an update on the global and local fixed income markets. To begin, I'll pass it over to Mr. Lodevico Ulpo.
Good morning. Thanks for having me. Dustin have provided broadly into where among the asset classes we see the bright spots on a relative risk-reward basis. So I think the message is clear that in these unprecedented times, it would be best to diversify your risks and seek shelter through the fixed income asset class, but remaining mindful of the risk investors face in choosing products within this investment space. So to this, I will give you an update on what is happening on the global fixed income landscape, and then provide outlook on global rates and credit, as well as our very own local fixed income market. Next slide, please. So yes, so this March, we saw heightened uncertainty in the market caused by the global pandemic, so spurring volatility in the risk markets. So as the market sought safety, we saw US Treasury yields hitting 150-year low. So that's quite a long time, signaling fear and providing an indication of what many are afraid of. So I think from the news, you're seeing some thoughts that there might be a deep recession coming out. So you see US Treasury yields falling to as low as 0.5%. Right now is at 0.7%, but it has been quite volatile over the month of March. So yeah, global policy makers around the world have responded aggressively via coordinated monetary and fiscal accommodation. So as Dustin mentioned a while ago. So just to reiterate that on the monetary policy side, which is affecting fixed income markets, major central banks have eased policy by cutting benchmark rates and injecting massive amount of liquidity into the system. So in the US specifically, the Fed has cut to zero and has instituted an open-ended QE, quantitative easing, to inject liquidity by buying specifically US Treasuries, mortgage bonds, and investment grade bonds. So what does that mean? So increased liquidity, lower interest rate means positive for fixed income, pushing the yield curve lower. On the fiscal side, however, governments globally have responded by a significant amount of spending. So what does that mean? That means that government are recording significant amount of budget deficits, which elicits large amount of bond supply. That's bad for bonds. So given this push and pull of positive and negative factors, this have created a lot of volatility on US Treasury rates. So right now, we see that there's value on the long end, but the steeper curve is just a reflection of funding. So more bond supply on the longer end means it's bad for bonds, but safe haven means it's good for bonds. So there's some contradiction into global fixed income, specifically on US Treasury rates. However, we view this environment as a perfect time to trade. So being opportunistic, looking at specific levels to position. So right now, we are doing that on our total return dollar bond fund. Dustin mentioned a while ago the factors affecting rates, and we've been capitalizing on those volatility. So buying when yields are high, and then trading when yields have shifted significantly lower. Next slide. Okay, so within the global fixed income space, this is the risk that my colleague has been highlighted now. This credit markets and the spread sector. So similar with the equities market, the hard currency credit sector has suffered the brunt of the selling in March. It's because it's still a risk asset. So credit spreads were wider. So if I reference on the right-hand chart, global credit spreads were wider by 150 basis points from below 100, and now it's around 250 back to 222. And then for EM spreads wider by 300 basis points. This is not yet at the wides relative to where '08 was. So we might see another leg down of credit spread widening. So that's a risk yield or income seeking investors should look at. No. So in terms of this, I think I'll just highlight the risks on the presentation. So the first one is sovereign credit risk. Risks are elevated because of the significant amount of spending. So that's denting the quality of sovereign credit around the world. Significant demand shock puts corporate debt service at risk because the corporates, the revenue is declining, but their fixed cost is not necessarily going down. So there's a margin squeeze, which means that cash flow to service interest, principal payments will be challenged. And another thing to highlight, I think globally, in the US, in Europe, and here is the banking sector asset quality. Why is that? Because consumers, SMEs, and corporates may actually experience cash flow strain because of this lockdown. There might be delays in credit card payments, loan payment, auto loan amortization. So that is actually another risk that we see that the banking sector may face. So loan defaults, NPLs might actually further widen out credit spreads in the market. So what do we think about these risks in the credit space? We think that safety is paramount. Sovereign credit risk is favored against corporates. I think my colleague has been highlighting on that. Within the corporate space, we like investment grade over high yield, developed market over emerging market, and on a sectoral basis, we like strong corporates which are consumer staples, which you see a more stable type of spending or demand, and then over consumer discretionary, the likes of your autos, restaurants, and some sectors like that. However, as I have highlighted the risk, I think we have to look at it more that this has created a lot of dislocations in terms of value. So from a risk reward perspective, we would like triple B investment grade sovereign credit. So what are those? Philippine dollar denominated bonds. We think that on a relative basis, Philippines is still good, and triple B sovereign credits are actually benefiting from the peripheral quantitative easing of the Fed. So before I go to the next slide, let me just highlight to you that in the global space, the way to play this one is that for interest rates or US treasuries, it's very tactical in nature. So it's very trading oriented. And then on the credit space, it's very selection oriented. So there has to be a lot of due diligence, balance of risk and reward. And in our fund, we have actually switched out a lot of we have completely zeroed out on our corporate holdings way back in February, and shifted to more sovereign, and we have capitalized on the trading side on US treasuries. Next slide, please. So for local rates, for Philippine fixed income, I think this is the bright spot among the asset classes mentioned. This provides the most decent risk reward and the balance between providing return and capital preservation. So in the short term, however, I mean, the Philippine fixed income have generated a little over around -1%, but it has it still makes your capital intact, and the yield or the accrual will actually take over that negative return in the short term. However, I think from a policy perspective, the core fundamental factors affecting local fixed income such as a possible recession in the near term, declining inflation trend should spur an aggressive accommodative response from our BSP. So just a quick rundown of what has happened. The reserve requirement ratio, which is now 12% after 200 basis points cut this month, our team forecast this to be around 9 to 10% by year end. So that's additional 200 to 300 basis points in reserve requirement cut, which is an additional liquidity in the market, pushing rates lower. And on the policy rate perspective, it's now at 3.25%, 75 basis points cumulative cut for the year, with inflation expected to go down. And as economic activity weakens, we believe that future cuts are very likely. So I think every fundamental factors in the local fixed income peso is pointing that rates are going to go lower. I think with rates elevated right now, it's very artificial, and it's just because of some work conditions, reduced liquidity because of immediate work from home protocols and treasuries adjusting to the new work environment. Again, I think for this, in terms of positioning, we would prefer high duration or long-term bond securities, as this benefits the most in terms of capital appreciation with the yield curve, yield trend going lower. Next slide, please. So just to have a recap for local fixed income, we want it to be very strategic. What you need to know right now, you just need to know the facts that the BSP are the fundamental factors are pointing to lower rates. And while the 10-year is still at 4.8%, I think it's a very good way to invest. And I think that our fund, the Total Return Peso Fund, is positioned for that type of environment. So just to recap my presentation, so I just need you to remember 3 V's. The first V is the virus which has evolved into a global pandemic and is affecting everyone's way of living. Then the second V, so let me just give an update on this. So when I made this presentation 3 days ago, the total number of cases, it's around 787. Right now, it's north of 900, and the total deaths is 37,000 now. It's more than 40,000. So this picture has been evolving on a daily basis on a very significant or higher rate. We have to monitor this as this can cause significant amount of factor in terms of how investors position, which has created my second point, volatility. So volatility, this pandemic severely affecting financial markets, causing asset prices to incorporate heightened uncertainty, because no one knows if we're going into deep recession, how shallow the recovery, or who knows, right? And this uncertainty is creating fear, resulting to large price swings. So on your right-hand side, this is a measure of volatility. We're at the highs now. I think this is around the 70. So we're nearing peak around the 08 levels. In terms of, so for positioning, it's very volatile. And then lastly, V for value. Volatility is actually causing assets to look cheap. However, and just a caveat on that, one should exercise extra due diligence on selection, as we are not out of the woods yet. Everything is evolving right now. Earnings and economic estimates have yet to be revised downward. So who knows how bad the picture will be in the next 1 week, 2 weeks. We won't know. So I think the value proposition is hard to gauge at the moment. You have to do extra due diligence. And for fixed income, in this environment, we just have to be agile and dynamic in our portfolio positioning. For US Treasury, you have to have a trading approach, tactical positioning. For hard currency credit, there has to be defensive and value mindset. For local fixed income, it has to be very strategic. You just need to know all the factors, and the factors are that rates are gonna go lower. So with that, I end my presentation, and Dustin and I are happy to take your Q&A. Thank you very much.
Okay, thank you for your insights, Devi. And thank you once again to all our speakers. What we're gonna do now is open up the floor to a few questions from the audience. We've received a lot, so thank you so much for all the questions so far. I'll start with the first one for Dustin. So you said a possibility in terms of your portfolio is to seek active management. However, you've chosen our local index, the PSCI, as a selection choice. Is there a reason for this?
Yeah. So when I suggested that you seek active management, I was referring specifically to the global equity sleeve. Obviously, global equities a lot more complex, a lot of more levels to look at as compared to just Philippine equities. So when it comes to allocating into global, I recommend going for an asset manager you trust, an asset manager that's always actively managing their portfolio, and not just like an ETF that will buy whatever stock that has the largest market cap. So for the global equities, I think active selection is key, given that we are expecting a lot of credit defaults, expecting a lot of business closures. In terms of the Philippine equity space, we have less options to select from within the space. There are a lot of funds within the Philippine equities. I think ATRAM is very well known for their active management in this space. I want to highlight. And actually, what we are suggesting in the Philippine equity space is to invest in blue chip names, just because when we see the market recovering from the lows, we expect it to be driven by foreign inflow, and foreign investors will inevitably flock first into these blue chip names. So I'm just saying, in the context of everyone, we have our existing investors and some retail investors, maybe some people that are not invested with us yet. I'm saying that an index fund is okay to take advantage of that move, but if you're already invested in the Equity Opportunity Fund, which is our own Philippine Equity Active Management Fund, you can be reassured that it's already invested in the best blue chip names, and we've selected those very meticulously.
Dustin, if I may just add to your answer.
Yeah.
I agree with Dustin's view. Just so you have some details, and I know there are some questions about what to do as far as Philippine equities are concerned. Should you be buying now? The Equity Opportunity Fund today, the top 10 are very familiar large cap index names. They make up about 74% of the portfolio today, versus the index, which those same names make up less than 70% of the portfolio. So we've certainly added, our active management view has added weight to these top large caps that we feel will survive this crisis and thrive beyond it. Don't want to also leave out the Alpha Opportunity Fund, because I think that is a selection choice for folks. From a thematic point of view, it is looking at the same thing. Who is going to survive and thrive beyond this crisis? It's a higher risk fund. Today, 66% of that fund is invested in the top 3 holdings. Almost 40% invested in its top pick, which is Pure Gold. And we know Pure Gold is a key company today providing access to food at the crisis level, but we think, again, beyond the crisis, will continue to grow. The next 2 holdings there are First Gen and Wilcon, which are a power company and and Wilcon Home Supplies. And we think, again, although power demand has been low, we expect that power demand will pick up as soon as quarantine is limited, or the restrictions are relaxed slightly. So these are two active management strategies that we think might bode well. Obviously, at this point, we would favor the large cap exposure via equity opportunity fund. And if you wanted to take a little bit more risk, then the Alpha Opportunity Fund will provide you that. Thank you.
Let's keep our Chief Investment Officer on the line, since we're already discussing companies themselves. I have a question over here about the industry of telecommunications. Is it the right time to buy PLDT and other companies within the industry? And what is the outlook for the telco industry for the rest of the year?
Well, I think it's obvious now how important this group of companies in the telco space are. I don't think there's any question anymore about whether they need to invest in 5G technology. That will continue. I think the environment today puts an advantage on the two incumbents. So both Globe and PLDT should do well in this environment. As a matter of fact, their performance for the year have been among the better performing stocks. They are providing the connectivity that allow us to do this call today, for example. So we have been adding weight to our telco exposure. It's a sector that we've been severely underweight for many years, but we think that there is a new horizon for them and a new opportunity. So it is a sector that we are adding exposure to at this point in time.
Okay, thanks, Phil. One for Devi for fixed income. A question over here about the US. America has now exhausted every tool in the toolbox. For example, its rate already at zero interest. If a deep recession occurs now, what do you think are other options for them to counter this situation?
All right, so thank you for that question. I think that's very insightful. The Fed has exhausted the policy rate cut option. However, what the Fed has been doing is to do a QE. There's a lot of direct options for the Fed. So, for example, the Fed can increase the dispersion of the QE. So right now, the Fed has just been buying treasuries, mortgage bonds, and have instituted some part of the investment grade side. I think the Fed can inject money towards or provide lifeline to SMEs. And I think that's not yet exhausted. The Fed can put some more money into the liquidity of this troubled company. So that itself extends the life as we address this prolonged effect of COVID.
Okay, thanks, Dev. Since we're talking global, let's talk about our local fixed income. Do we expect local fixed income to provide stability given what's happening to the global financial markets?
Yes, I think from a policy standpoint, the BSP and the BTR are in very good. They're communicating. So I think from this standpoint, I think from a fundamental perspective, with inflation going down, there's a lot of room for the BSP to reduce borrowing rates and inject more liquidity into the system. So that itself pushes rates lower. And when rates go lower, you'll expect price gains from your portfolio. And that actually provides not just stability, but modest amount of return to maybe add or offset some of negative on the risk asset sides in your portfolio.
Okay, thank you, Deb.
Sure.
And I have one over here regarding something we're all interested in, the oil market. So I'll give that one to Dustin. What do you think would be the effect in the market once oil price may plunge due to oversupply, however less demand due to quarantine worldwide?
Okay, so I think oil prices you've already seen fall spectacularly. Actually, I think yesterday or 2 days ago we hit below $20 per barrel. The last time this happened was in 2015 and 2016 when the US introduced fracking in the industry, basically in effect also introducing like a price war, given that they can produce oil at a lower cost. So what we're seeing is it's a price war between Russia and Saudi. They're pumping out so much supply into the market amid an economy that is not demanding as much. So that's why the price of oil has gone down this low. And unfortunately, it is overall it is quite negative for markets. But we have to keep in mind that there are some economies, particularly the Philippines, that benefit from lower oil prices. There are also a handful of emerging markets that operate the same way because we are an oil importer. Lower oil prices actually benefit us. The problem for countries like us is that on the demand side, we're not demanding as much either. Um, but you know, as economic cycles come and go, as real business cycles operate, you'll typically see prices. You'll typically see prices come down and demand come down to up to a certain point. But once we see some pickup, once the price level comes down so low to the point that it makes sense to demand more oil at that price, you'll start to see a pickup. When that'll be, I'm not quite sure. That's the $1 million question. But that is bound to happen at a certain price point. It makes sense to start buying. It makes sense to start increasing demand for it. And the next cycle, the next stage of the real business cycle is for the price to return back to normal levels and be reflective of the increased demand.
Okay, thank you, Dustin. We'll stay with you. We have a question on something you said about PE ratios. Your statement is that the PE ratios moved down from 16 to 10. However, that's based on past profits, while the stock price represents the NPV, or net present value, of future profits. Additionally, we have an increased discount rate plus an increase in risk, both defending lower PE ratios. In 2008, we experienced the same. Would you know what the actual decrease of the PE ratios have been in 2009 and 10 compared to 2008 based on actual profits?
Okay, so in 2008, and this is for the Philippine equity market, in the GFC, the PE ratio from the peak to the trough fell 52%, and today it's fallen 33%. And you are correct. That's a very good assessment. That the E in that PE is actually suspect because that is a forward earnings estimate, and the earnings downgrades haven't been imputed yet into that PE estimate. It's not a consensus view yet, but our internal equity research team is putting that earnings growth estimate at negative 3%. Right now, the consensus estimate is still close to 10%. So once the PE ratio realizes that correction, you can expect the PE ratio actually to jump higher. And once people realize that that adjustment has caused PE ratios to climb, you may expect further downside of around 10% more.
Okay, thank you, Dustin. Let's go back to Devi. This is in terms of an outlook on FX, right? What's the USD Philippine peso FX view, given all the factors that you've mentioned?
All right. So I think there's no definite single number to point it out, but I think I'll probably give more of a range. Given what's happening right now and with the BSP looking to ease more, the interest rate differentials are not going to bode well for the Philippine peso. No, so for right now it's below 51. We expect this to be at around of range of 51.50 to 52. our regional peers have actually been experiencing some weakening. With us remaining to be an emerging market, we are still at the mercy of global flow. So that's actually going to affect the peso, and we expect some sort of weakening, but at a more measured pace. No, so we won't see a significant shot up, meaning the peso weakening to 50, 54 right away. It's going to be gradual, so you'll see some adjustments on levels. Right now, we think that the range is 51, 50 towards 52 area. Thank you.
Okay, thanks, Deb. Going back to Dustin, you mentioned that ATRAM's overweight on fixed income. Can you share what specific products under ATRAM's fixed income group you recommend?
Okay, so specifically, we have the ATRAM Total Return Peso Bond Fund. This is for the Philippine fixed income space, and it's being managed by Devi himself and Miguel, our head of fixed income, and they have outperformed the market this year, and we have full trust in them. This is where we get our Philippine fixed income exposure, also very actively managed. Um, Another thing I'd like to highlight is our global fixed income fund, which doesn't get enough attention. Typically, and it's called the ATRAM Total Return Dollar Bond Fund. And under normal times, and this is before the COVID-19 outbreak, it has been holding more Asian corps, dollar corps, and this is the thing I wanted to highlight, is that active management in the global space is very important, and this is also being managed by Devi. He's actually shifted totally out of corporate credit, given that credit defaults are expected to happen, and you don't see that very often, where a bulk of the portfolio, are more than 70% was in corporate credit, and now we're totally out, and it's now in ROPs and U.S. Treasuries. Um, Dev, if you wanna share some points on that fund, go ahead.
Yeah, so we were able to capitalize on this insight back in early February, where we think that the global economy might experience some strain. In this type of environment, corporates tend to have a bit of a significant amount of challenge. And if you look at 2008, it's a credit crisis, and it has created a lot of problem both on financial markets and on the economy. So from that perspective, we have shifted significantly out of corporate towards sovereign bonds investment grade. So Philippine Sovereign Dollar Bond Fund. So from being a purely credit fund, we have shifted entirely into ROPs and have benefited on the volatility of US Treasury rates. So we've been trading actively US Treasuries, using the 30-year as our instrument to trade the volatility. So making points here and there. And then on our core positioning, we have shifted towards investment grade, that's ROP, which is triple B on the high side of the middle of the credit investment grade spectrum. We do not foresee downgrade towards double B or high yield. So from a flow perspective, with the Fed injecting money across the board and into investment grade, we are seeing some sort of credit spread tightening on sovereign bonds, but that's not happening in corporates. The reason being is that the corporates are experiencing a lot of top line pressure, meaning revenues declining. I'll just give you a very simple example. With this lockdown, the top line are going to shrink, and your fixed cost, wages, rent, and everything, it's not going to be waived. So your squeeze of margin will actually put some cash flow burn into your balance sheet, and then the cash flow burn resulting from that phenomenon will decrease your balance sheet cash and will challenge your liquidity. So that in itself is lending the credit markets towards another wave of maybe credit review, credit rating downgrade, refinancing pressure. We don't see that in sovereign bonds because sovereign bonds are, especially the investment grade, are viewed as safe and at least from a default perspective, especially investment grade bonds. Yeah, so it's just a question of how we rotate our portfolio. Dustin mentioned it. It's more really about active management, and we have benefited from the insights we were working on the past few months on this. Thank you.
Okay, thanks guys for answering that one. Let's bring back our Chief Investment Officer for this question. The speakers today mentioned market volatility due to the global pandemic, and rightly so. It's a simple one. Is it good news for us investors?
Thank you, Santi. Let me make it absolutely clear that a global pandemic and volatility because of that is never good news for investors. It doesn't mean, though, that we can't look at opportunities. And I think from a Philippine investor standpoint, we have to draw some positives. Number one, from the fact that I think the Philippine balance sheet is stronger than it's ever been. So we can withstand this. We will get through it. It's a matter of time. And the shorter, the better. The other positive that I see from this is Filipinos are generally not invested in equities. Maybe this group listening here is, but for the larger part of our population, this could be a significant opportunity for you to invest in equities, where you can buy the best of breed companies at very cheap prices. I do caution that you don't go all in all at once. This is likely to persist for a quarter or two. There's going to be good opportunities in that time to build your positions. But you cannot ignore this. And I think if there is any good news to talk about, it is that I still believe the future for the Philippines is very bright. We will get through this, and you need to take advantage and look at what opportunities are out there, and hopefully we can help you with those decisions. So please keep the questions coming, and we'll try to address every single one of them if we can, and hope that we can guide you and help you along the way through this investment journey. So again, thanks so much for joining us today.
Okay, thanks, Phil, for the positive reinforcement. I think for time check, we're a little bit over. I hope that's okay. I think we can leave it here for this call. Thanks to all our speakers and to our audience as well for all the questions. We received a lot today. If you have any further questions or would like to learn more about ATRAM strategies, please get in touch with your relevant ATRAM relationship manager. Lastly, a recording of this webinar will be released to all of you as well as posted on all our social media pages shortly. We appreciate you taking the time to join us, and on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe and have a great afternoon.